Welcome to The Explainer. Today we're talking about a company that is quite literally the plumbing of the internet, Cisco. Fiscal year 2024 was huge for them, not just because of the numbers, but because they made a massive, once-in-a-generation debt on where the future is headed.
You know, it's hard to really wrap your head around just how essential Cisco is. If you're watching this right now, chances are you're using Cisco tech. For decades, they've been the ones building the core equipment that connects and secures, well, everything.
But even the biggest players face challenges. And this past year, Cisco hit a pretty serious one. After years of growth, their annual revenue actually went down, which, for a company this big, gets everyone asking questions.
And that's what makes this story so compelling. Because while on the surface it looked like a downturn, what was happening behind the scenes was the single biggest strategic move in the company's entire 40-year history. A pivot to completely redefine what Cisco is.
All right, let's get into it. To really understand why this pivot is such a big deal, you have to appreciate the absolutely colossal scale Cisco operates on.
I mean, just look at these numbers. It's not just a company, it's practically a global utility. Seeing over 400 billion security events every single day. That gives them a view of the internet that almost no one else has. That deep integration is their superpower.
Okay, so with that scale in mind, let's talk money. Let's look at the financials for fiscal 2024, because the numbers here really tell the story of what was going on. So Cisco brought in $53.8 billion in revenue. That is a massive number, no question. It keeps them right at the top of the tech world. But that number alone doesn't give you the full picture. And here's that context. That $53.8 billion was actually down 6% from the $57 billion they made the year before. So after a period of really strong growth, you can see things were starting to shift.
So why the drop? Well, you can see it right here. Networking, the routers and switches that built the company, is over half their business, and that segment was down 15%. What happened was pretty simple. Customers had ordered so much hardware in the years before that they basically hit pause to get it all installed and running. And that slowdown is what set the stage for a really dramatic move.
And that brings us to the main event, the absolute centerpiece of Cisco's entire year, their biggest, most important acquisition ever.
In March 2024, Cisco spent around $27 billion to buy a company called Splunk. Let that sink in. They spent about half of their entire yearly revenue on one single deal. It's a jaw-dropping bet.
And the CEO, Chuck Robbins, he lays it out perfectly here. This wasn't just about buying another company. It was about buying a whole new capability. It's a strategic shift from being the company that just connects everything to being the company that understands everything. And this deal rockets Cisco right into the heart of a huge tech trend called observability. The easiest way to think about it is this. If Cisco's traditional network gear is the body's circulatory system, then observability is the nervous system. It's the power to see, analyze, and understand everything that's happening inside these incredibly complex systems in real time. And Splunk is the king of that world.
So you're probably asking, how does a company's revenue go down? They spend $27 billion on a purchase, and they still keep their investors happy. Well, the answer is pretty surprising. They did it by giving a ton of cash back.
In the very same year they made their biggest acquisition ever, Cisco turned around and handed over $12 billion directly to their stockholders. It was a massive signal to the market saying, don't worry. Even with this huge transformation, we've got you.
And this number is just wild. They returned 119% of their free cash flow. That means they paid out more money to stockholders than the company actually generated from its core business that year. That's a huge statement of confidence in their future.
And they did it with a classic 1-2 punch. First, they paid out $6.4 billion in direct cash dividends. And second, they spent another $5.8 billion buying back their own stock, which helps boost the value of the shares that are left.
Okay, so where does all this lead? Now that the Splunk deal is done, Cisco is trying to position itself as the go-to platform for the age of AI. But of course, the road ahead is packed with both incredible opportunities and some pretty serious risks.
And this is the core tension for Cisco right now. On one side, The opportunity is huge. Combining Splunk's data insights with Cisco's network knowledge could be a goldmine for AI. But on the other side, you've got fierce competition, the massive headache of actually integrating these two giant companies, and just the chaos of global supply chains.
So that leaves us with the big final question. For decades, Cisco built its empire selling the hardware that connects us. Now it's betting everything on becoming a software and AI platform that understands those connections. Will this historic, expensive pivot actually work? Will it secure their spot at the top for another decade? That is the multi-billion-dollar question everyone in tech is watching.